Hello everybody, welcome to the core content lecture. This one will be focusing on asset synchronization. So getting started with trusting price runs. After narrative has been established, when the stronger asset breaches external or internal liquidity first, the asset in the middle has a high chance of following suit. So during this time, it is permitted to ignore the signatures in price, opposing the narrative. So what do I mean by that? Well, if we pull up a short diagram right here, after a true reversal has taken place and you are targeting, let's say, external liquidity that is far out on the higher time frame, as we can see, the asset on the left has taken out that external range liquidity first. Let's say the asset on the right, it would be the asset in the middle and has yet to take out that external liquidity. Due to the asset on the left being stronger, there is a very high probability that from that external liquidity to where the market is currently trading at and how the asset in the middle is lagging behind, there is a high chance that it is likely to also run to that external liquidity. So you can frame a lot of different trade setups with this. And this is what I call in the live streams, quote unquote, catching up, where one asset has to play catch up with another one. But here you have it in a little bit more detail and understanding when it should form. So if you're expecting an asset to play catch up, let's say, for example, the asset on the right, if something bullish were to form and you're targeting external liquidity that's below market price, you would ignore that bullish signature in price, and if anything, use it as what? A continuation, for example, a continuation TPD, and allow that to offer lower prices going towards the same external liquidity that the stronger asset has already tagged into. And with this isn't something that's easy to go back test and see. You have to really see it live while it's printing to understand it. But for now on, once a target gets hit on a certain asset and you're expecting all three of the assets to hit that same target, study what happens on the middle asset and the weakest asset after the strongest asset takes out either internal liquidity or external liquidity, depending on the narrative. And you'll see this exact phenomenon. But now, adding on to that with functions of the Dow. So generally starting at 925, the Dow will begin to move on its own accord, but exactly at 930, you'll see its predominance. So the Dow has two functions at this time, either manipulation or foreseen distribution. So understanding the current narrative and asset synchronization tells you which one it is, whether it is manipulation or foreseen distribution. So again, with the diagram, the example on the left would be manipulation and the example on the right would be foreseen distribution. So let's say the narrative was bullish and you were targeting higher prices at 930. If the Dow moves on its own accord and trades lower and offers a sharp decline in the market, what you're looking for is for this run to cause either sequential SMT or a TPD or something along those lines upon that drop, and this will serve as manipulation to trade higher towards that higher time frame draw on liquidity. But let's say the Dow just immediately trades higher upon the opening bell at 930. Then you would look at this as foreseen distribution. And if anything bearish forms, you would ignore it. And you would look for the other assets, being the S&P and the NASDAQ, to quote unquote play catch up or synchronize in accordance to the Dow towards that higher time frame draw on liquidity. So manipulation would be if the Dow pretty much fades the higher time frame narrative and trades opposite to it. You would view that as manipulation and you would view it as a cracking correlation. But if the Dow immediately trades towards the higher time frame draw on liquidity upon the 930 open, then you would look at that as foreseen distribution for the other two assets and ignore any signatures in price opposing that higher time frame draw on liquidity. Now I know this video was a little short, but trust me, if you really go back and look into this, it is very powerful, and if from now on your viewings in price, you'll be able to know when to trust the Dow and how to properly navigate taking information from the Dow, as well as other assets for knowing whether price should continue or reverse. So hopefully y'all found this one insightful. I'll speak with y'all again soon. Good luck and good trading.